Welcome back to the Deep Dive. Today, we are absolutely going to the mat with a topic that, I'll be honest, has a bit of a reputation. We're talking about SAP sales and distribution, or, SD as the cool kids call it. And I have to admit, when I first saw this on the schedule, my brain immediately went to data entry.
That is the classic reaction.
Right. I mean, the stereotype is that SD is just the module where you type in the sales orders, you sit there, you click a few buttons, generate an invoice, and then, I don't know, go to lunch. It feels very administrative.
It does, and that misconception is probably the single biggest barrier for people actually understanding how an enterprise really works. If you view SD as just order entry or like a fancy typewriter for invoices, you're missing about 90% of the picture.
90%. Wow, that's a massive blind spot. So let's just shatter that illusion right off the bat. If it's not just typing orders, what are we really dealing with here?
We're dealing with the commercial nerve center of an enterprise. Think about it for a second. This isn't just about recording a sale. This is the engine that governs revenue. It controls pricing, delivery logistics, billing, and the flow into accounting. It's the digital representation of a company's entire market strategy.
So less of a typewriter and more of a central nervous system.
Exactly. And that's the lens we need to use today. We're taking the senior consultant mindset. A junior consultant asks, how do I create an order? A senior consultant asks, how does this order affect the company's bottom line and its legal standing? When you look at it that way, SD forces a business to answer 5 absolutely fundamental questions, and it demands answers with zero ambiguity.
Okay, I love a good framework. Let's walk through these 5 questions. What's number 1?
First, who is the customer? And that sounds simple, right? It's Bob. But in SAP, Bob isn't enough. Is it the person paying? Is it the person receiving the goods? Is it the corporate entity negotiating the price? Are they even creditworthy? The system forces you to define who with extreme precision.
Okay, so we can't just say the customer. We have to really dissect them. What's the second question?
Second is, what are we selling? Is it a physical widget that sits on a shelf? Is it a service like consulting hours? Is it a warranty? Or maybe a third-party item that we don't even touch?
Right, because selling a box of screws is totally different from selling, say, a maintenance contract.
Precisely. The system behaves completely differently based on that what? Third is, how is it delivered? Which plant does it come from? Which loading dock? Which truck route?
Who, what, how. Got it. What's number 4?
Number 4 is when. But not just delivery date. We mean, when does ownership transfer? This is where we get into things like Incoterms. Does the risk transfer to the customer when the truck leaves our dock or when it arrives at their front door?
That's a huge distinction. If the truck crashes in the middle, whose problem is it?
Exactly. SD defines whose insurance pays out. And finally, the 5th question is where. Specifically, where does the financial impact flow? Which general ledger account captures the revenue? Which bucket does the tax go into?
Okay, that last one feels like it's drifting a little bit into finance territory.
And that is the secret sauce. Everything in SD, every single table, every configuration node, it all exists to enforce the answers to those 5 questions, systematically and auditably. We aren't just processing transactions, we're building a legal framework.
That's a huge shift in perspective. So it's not just data, it's law and money. So our mission today is to move from that transactional view, just memorizing T-codes, to a process view. I know we've broken this down into the skeleton, the muscle, and the movement.
Right. The structure, the master data, and the stock.
Let's start with the nature of the beast. You mentioned the process view. In the notes, there's this contrast between happy path thinking and process orchestration. Can you unpack that for us?
Sure. The happy path is what you learn in a basic training course or, a boot camp.
Cool.
You memorize a linear sequence. You go to transaction VS01 to create an order, then VL01 to create a delivery, then VF01 to create an invoice. It's clean, it's straight.
And it creates a nice little document flow.
It does. And I'm guessing that almost never happens that smoothly in the real world.
Yeah, that was my next question.
Almost never. Because the real world is messy. Real life involves complex value chains. It's not just order to cash, it's quote to order. Or think about returns management reverse logistics is incredibly complex.
Oh, right. Because if I return a laptop, you don't just undo the sale.
Exactly. You can't. You have to authorize the return, receive the goods back into a specific return stock category because you can't sell a used laptop as new. Then you have to inspect it, issue a credit memo to the customer, and maybe trigger a repair order. That is process orchestration.
That creates a whole web of dependencies.
It does. Think about consignment, where we put our stock at the customer site, but we still own it until they use it. Or intercompany sales, where our French subsidiary sells to a customer, but the goods ship from our German factory.
And if you only know the transaction codes, the happy path, you're completely sunk when a client asks, how do we handle a partial return of a third-party dropship order?
You're lost. You're completely lost. That's a process question, not a T-code question. And this leads to the biggest reality check for anyone stepping up to a senior role. SD sits right at the intersection of 4 major domains.
It's the hub of the wheel.
It really is. You have materials management for sourcing and availability. You have FI finance for revenue recognition and tax. You have co-controlling for profitability analysis. And you have PP production for demand planning.
So it sounds like SD is the one module that can't really survive on its own.
It can't. And here's a statistic from the research that really just stood out to me. 70% of reported SD issues are actually integration issues.
70%, that is wildly high.
But it makes perfect sense when you think about it. A user screams, I can't build a customer, the system is broken.
Mm-hmm.
The junior consultant looks at the billing configuration and sees nothing wrong. The senior consultant, they look at the integration. They check the customer master and see that the finance team has placed a posting block on the reconciliation account because the customer hasn't paid their bills in 6 months.
So it wasn't an SD error at all. It was finance doing their job, and SD was just respecting that.
Exactly. So the consultant is really a translator. Your job is to take business language. We need to sell widgets to France, but build them in Switzerland, and map that to SAP logic. You aren't just clicking buttons, you are translating business intent into a rigid, auditable system.
Let's get into the mechanics of how we build that system. We called this the skeleton, which is the organizational structure. I really like the waterfall analogy used in the material. Can you walk us through that visual?
Yeah, sure. Visualize a cascading waterfall. At the very top, the highest level, you have the legal layer. This is the company code.
The bucket that catches the money.
Correct. The company code represents a distinct legal entity. It's the one truth for financial statements. This is where the balance sheet and P&L live. If you sell in US dollars, but your company code is in euros, the system automatically handles the exchange rate gains or losses right here.
And there's a trap here for the uninitiated, right? The cross-company trap.
Oh, it's a classic mistake. Imagine you have Sales Org A, which is assigned to company code 1000 in the US, but they sell goods that are physically sitting in plant B, which belongs to company code 2000 in Germany.
So I'm selling your stuff, basically.
Exactly. You cannot just map them together directly because they are different legal entities. You can't just take stock from a German company and give the revenue to an American company. The tax authorities would. Well, they'd put you in jail.
Right, that's tax evasion, or something close to it.
Or at least transfer pricing fraud. So this triggers a whole intercompany sales process. The German company physically ships the goods to the customer, but legally sells them to the U.S. company, who then sells them to the final customer. The system handles all those invoices in the background. But if you just try to wire the U.S. sales org to the German plant without that configuration...
Computer says no.
Computer says no, and the auditors say absolutely not.
Okay, so below the company code in the waterfall, we have the commercial layer.
Well, this is the sales organization. Think of this as the team throwing the money into the bucket. The sales org is legally responsible for the product. If the customer sues because the product broke, they sue the sales org.
And the notes mentioned a real project insight here about over-designing. What's the common mistake people make?
The mistake is mirroring your internal HR chart instead of your legal structure. People want to create sales org north and sales org south just because they have a manager for the north and a manager for the south.
Sounds logical, though, on the surface.
It sounds logical, but it's a trap, a huge trap. If they are the same legal entity, keep it one sales org. Use sales offices or sales groups for reporting on north versus south. If you create 2 sales orgs, you have to duplicate your pricing, your master data, and your configuration for every single one. It becomes a maintenance nightmare.
So the rule is, keep it simple. Don't build structure you don't actually need.
Exactly. Next down the waterfall is the strategy layer, the distribution channel.
The pipe through which the money flows.
Right. Wholesale, retail, e-commerce. This is the primary driver for price differentiation.
Because I'm going to charge a different price to a wholesaler buying 10,000 units versus a retail customer buying just one.
Precisely. Same product, different channel, different price. And below that, we have the product layer, the division. So motorcycles versus soft part parts versus apparel.
And when you combine those three, sales org, distribution channel, and division, you get something the sources call the Holy Trinity.
The sales area. This is arguably the most critical concept in SD structure. Customer master data and pricing exist at this specific level
Why is that distinction so important? What's the why behind that?
because it acts as a gatekeeper. If a specific combination, say sales org, Germany, wholesale channel, motorcycle division, is not explicitly configured, you cannot create an order for it. It simply doesn't exist in the universe of the system. You can't sell a motorcycle through the service channel if you haven't set up that sales area first.
It forces you to be intentional about what you sell and how you sell it.
Exactly. Total control.
So we've got the legal, commercial, and strategy layers. Now we need to get physical, the logistics layer.
Right. So we have the plant. In SD, we usually call it the delivering plant. It's where the goods actually come from. And crucially, like we discussed, a sales org can sell from any plant as long as you configure the cross-company logic.
And inside the plant, what's the next level down?
Storage locations. This is where the picking happens. This is the shelf, the bin. If your order doesn't determine a storage location, you can't create a warehouse task. You can't pick the goods because the system doesn't know where to send the forklift driver.
And finally, the shipping point, the loading dock.
And the golden rule here is 1 delivery equals 1 shipping point.
Why is that a rule? Why is that so strict?
Well, think about the physics of it. You have a truck at the liquid dock pumping chemicals. You have another truck at the solid dock loading pallets. You cannot have a single delivery note that includes items from both of those docks because one truck can't be in 2 places at once.
That makes total sense physically, but I can see how you'd forget that when you're just looking at a screen of data.
It happens all the time. A user tries to put chemical drums and pallets on the same order, and the system splits it into 2 deliveries. They call the help desk saying, "It split my order." And the consultant has to explain, yes, because of physics.
So how does the system know which shipping point to use in the first place?
It uses a specific formula. The shipping conditions from the customer master-like as soon as possible, plus the loading group from the material master-like forklift versus crane, plus the delivering plant. It's a very rigid determination.
Okay, so we've built the skeleton, we have the structure. Now we need to put some meat on those bones. Section 3, the muscle. Master data.
Right. The concept here is that configuration, what we just talked about, defines what is possible, but master data decides what actually happens.
And apparently master data errors cause something like 80% of production support tickets.
It is the #1 culprit, by far. You can have the best configuration in the world, the most beautiful structure, but if the master data is wrong, the process fails. The machine just grinds to a halt.
Let's start with the customer master. It's described as a composite master. What does that mean?
It means it's not just one flat record like a contact in your phone. It has 3 distinct levels, and understanding this split explains why so many things happen the way they do. First, you have general data. This is at the client level. Name, address, tax numbers.
So if I change the address here, it changes for everyone everywhere.
Everywhere. Across all company codes, all sales areas, globally. If you have a typo in the address and the general data, it breaks REIT determination for everyone. If you change the name, it changes on every open invoice across the whole world.
Wow. High stakes. What's the second level?
Company code data. This is the financial link. The critical field here is the reconciliation account. This links the customer, who is a subledger, to the main general ledger.
Why do we need that link? Why can't they just be separate?
Because the finance team doesn't want to see Bob bought a widget and Alice bought a widget on the actual balance sheet. They just want to see one number. Total accounts receivable.
Wow.
The reconciliation account is what bundles all those individual customer transactions into that one single line on the balance sheet.
And the conflict here is that sales can't create a customer until finance opens this view, right? That's the bottleneck.
Exactly. You'll see sales consultants on a project just waiting on finance consultants to extend the customer so they can finally start selling. It's a classic project bottleneck.
And the third level.
Sales area data. This is specific to the channel. You might have different pricing or shipping conditions for the wholesale channel versus the online channel for the same customer. And the rule is simple. No sales area extension equals no order, period.
Okay, moving from the customer to the material master. What's the single most important thing to watch out for there?
The item category group. It's a small field, usually 4 letters like norm, DAN, or bands, but it determines the entire behavior of the product in the sales process.
How so? Give us an example.
Well, norm is a standard stocked item. The system knows to check inventory, schedule a truck, and pick it. DIN is a service. The system knows not to check inventory and not to schedule a truck because you can't put consulting hours on a pallet.
So if I accidentally label a service as norm,
The system will try to make you ship it. It will demand a shipping point, a weight, a loading group, and you'll be stuck because, well, you can't weigh a service.
one field, total process failure.
Exactly. It breaks everything downstream.
Now, there's a concept here I really liked called the ultimate override, the CMIR.
The customer material info record. This is a lifesaver. Suppose your internal code for a product is Pentium 500, but your customer, say Intel, called it ChipX. You use the CMIR to map their language to yours. So when they send an order for ChipX, the system automatically swaps it to Pentium 500.
But it does more than just translation, right? It's not just
Right.
a lookup table.
No. It overrides the master data. Let's say a specific VIP customer demands that this one material always comes from plant B, even though the standard rules point to plant A. Or maybe this customer is the only one who gets partial deliveries. The CMIR overrides the standard logic for them and them alone. It's the highest priority in the hierarchy.
That sounds incredibly useful for those VIP clients who just have to be different.
It is, but with great power comes a great responsibility. You have to maintain it. If that VIP customer changes their mind, you have to remember you have this hard-coded override sitting in the background.
Right. And the sources mention that governance is war.
It really is, because you have siloed ownership. Sales owns their tabs on the master data, finance owns theirs, the warehouse owns theirs. A senior consultant knows that you have to define ownership, a CI matrix, and then use required fields in the system to force discipline. You can't just hope people enter the data correctly. You have to make the system reject the record if they don't.
Speaking of enforcing discipline, that leads us perfectly into Section 4, the DNA, the customer account groups.
This is one of my favorite topics because it's so often dismissed as just a label. But the account group is the template that dictates the entire customer's behavior.
It controls what the sources call the pillars of control. Let's talk about the big ones mentioned here.
Right. It controls number ranges. So does the system assign the ID like 1, 2, 3, or do you type it in like APLE or Google? It controls field status, what is hidden, required, or optional. And it controls partner determination.
Let's break down the Z groups, the custom groups that you see in the real world. Let's start with the sold to.
Okay, so 0001 sold to. This is the anchor. The sold to is the legal buyer. They're the ones who place the order. All the sales area data is critical here because this is who we are actually selling to.
And 0002 is the ship to.
Right, the delivery recipient. Think of a warehouse or a specific store. A ship to doesn't care about pricing or credit limits. It cares about transportation zones and unloading points, the physical logistics.
And the note here warns about a common mistake, creating a new sold to when you just needed a new shipping address.
It's a massive mistake, a huge one. Let's say Walmart opens a new store. That is just a new ship-to-partner that you link to the existing Walmart sold to. If you create a whole new sold to for that store, you've basically created a new legal entity in the system. Now you have a split credit history, split reporting. The credit manager will scream at you because they can't see the total exposure for Walmart anymore. They just see 50 tiny exposures.
Got it. Then we have Z003, the payer, the wallet.
This one controls the payment terms and the credit exposure. Imagine that retail chain again, 50 branches. Each branch is a sold to, but they can all be linked to one single payer, the corporate HQ. If the HQ hits its credit limit, all 50 branches are blocked from ordering instantly.
That's powerful logic. It allows you to centrally manage the risk while still decentralizing the actual ordering.
Exactly. And finally, 004 is the bill to. It's just the mailbox. Who gets the physical or digital invoice? Simple as that.
Now there's one group that sounds like a video game cheat code, the one-time customer, CPD.
Yeah, we call it God mode. It's for walk-in customers. Let's say you have a factory shop and people come in off the street. You don't want to create a full master record for every single person who buys a t-shirt.
So what do you do instead?
You use a CPD account. It's a generic master record. When you create the order, the system pops up a window and asks, okay, what is the name and address for this specific transaction? You type it in manually just for that one order.
Why is it listed as a major risk?
Fraud. It's a black hole for auditors. It's very hard to track history because the data isn't in the master record. It's buried deep in the transaction itself. If you see a lot of high-value sales going through a one-time customer account, that is a massive red flag. Someone could be selling to a sanctioned entity or just, giving goods to their cousin.
So the design principle here is crystal clear. One role equals one account group.
Don't mix them. Never make a generic group that tries to be everything. By keeping them separate, you can enforce mandatory fields. For example, a payer must have a tax ID. A ship-to doesn't need one. If you mix the groups, you lose all that granular control.
Okay, we've built the structure, we've defined the data, we've set the rules. Now we have to deal with reality. Section 5, stock posting.
And here's the fundamental truth of it. SD consumes reality. It doesn't create it. You simply cannot sell what the system doesn't see.
So let's talk about how stock gets in there in the first place.
Yeah.
We have the Genesis movement types. The big ones are 561 versus 501.
Right. 561 is the big bang. This is used only during go live. You are uploading your initial stock balances. The night before you turn on SAP, you count everything in the warehouse. You say, we have 1,000 widgets. You upload that with 561. There is no purchase order, no vendor. It's just, here's what we have.
And if that upload failed,
Day one operations stop. Dead. You have nothing to sell.
Yeah.
You can't create a delivery if the system thinks your stock is zero.
but what is a 501? How's that different?
501 is for receipts without a PO during ongoing operations. Maybe a vendor sends you free samples. Or you find a box in the corner that fell off a truck a year ago and wasn't in the count.
It sounds convenient, but I assume there are risks.
Oh, yeah. It bypasses the standard procurement process. You're increasing your inventory value without a corresponding invoice. Finance generally hates Movement 501 unless it's very strictly controlled.
Now, the big one for SD consultants is the STO, the stock transport order.
This is where SD really meets MM. It's for moving stock between two of our own plants. But we don't just move it instantly like a magic trick. We use SD logic, we use deliveries to do it properly.
Walk me through the chain. Why use SD logic to move our own stuff around?
Because we want the documentation and the control. It starts with a purchase order from the receiving plant. Then SD creates a replenishment delivery from the sending plant. Then the warehouse picks and packs the goods. Then, and this is the absolute key, the post-goods issue. This triggers movement 641 or 643.
And at that exact moment, where is the stock?
It's in limbo. It has physically left the source plant, but it hasn't arrived at the destination plant. We call it stock in transit.
And why does this cause so many headaches?
Because ATP, the availability check, usually ignores stock in transit by default. Business users look at a report that shows total stock and they say, hey, we have 100 units, why can't I sell them? But they fail to realize those 100 units are on a truck somewhere in Nebraska.
They aren't in the building, ready to be picked.
Exactly. They exist financially, but they don't exist logistically for a new sale from that plant.
That seems like such a classic communication breakdown. The computer says yes, but reality says no.
It is, or you get the opposite problem. Stock exists, but I can't deliver.
How does that happen?
Usually that's because the stock is in the wrong storage location, or more commonly, it's in quality inspection status. If stock is in quality or restricted status, SD cannot touch it. It's there, you can see it on the report, but it's blocked until the lab releases it.
Or, as the notes mention, the stock is dynamically reserved by other open orders.
Right. This is the silent killer. You look at the stock report and see 50 units on the shelf. You try to create an order for 10 units, and the system says, 0 available.
Yep.
Why? Because 5 minutes ago, someone else placed an order for all 50 units. The system has already mentally promised that stock to them. To you, it looks available on the shelf. To the system, it's already gone.
It's spoken for.
Precisely. Understanding that dynamic availability is what separates a user from a true consultant.
So wow, we've covered a massive amount of ground here. We've gone from the high-level legal structure down to the nitty-gritty of stock movements on a truck somewhere in Nebraska.
We've built the skeleton with the org structure, we added the muscle with master data, we defined the DNA with the account groups, and we connected it all to reality with stock posting.
If you had to boil this entire deep dive down for our listeners, someone who wants to develop that senior consultant mindset, what is the final takeaway?
It's this. SAP SD is not about selling products. It is about selling correctly, legally, profitably, and repeatably. A junior consultant focuses on making the error message go away. They just want to click the button to get the order through.
And the senior consultant.
A senior consultant focuses on why the error message appeared in the first place and what business rule it is protecting. They understand that the error message is there to stop you from breaking the law or, losing a ton of money.
That's a really powerful distinction.
And I'll leave you with this one thought from the source material, which I loved. If SD is designed well, the business scales effortlessly. You can add new countries, new products, new channels without breaking a sweat. You just plug them into the framework you've already built.
But if it's bad, if it's designed poorly.
If it's designed poorly, chaos looks like automation.
Chaos looks like automation. Say that again?
You're just making errors faster and more efficiently than ever before. You're scaling your own mistakes.
That is a terrifying and brilliant thought to end on. View the system as a set of logical behavior switches, not just a list of transaction codes. Thank you so much for breaking all this down.
My pleasure. It was a lot of fun.
And to our listeners, thanks for diving deep with us. We'll see you on the next one.